This is On The Charts with Nick Radge, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
The information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the weekly edition of the On The Charts podcast, and this is the week ended for 9th of June 2017. The Australian market continued to slip after big falls in May, driven mainly by the banking stocks. And whilst banks did have some respite late in the week, they still closed 2 to 3% lower, albeit off their intra-week lows. They're probably a little bit overdone on the downside for the moment, and whilst there's scope for a bounce, we're expecting another leg lower eventually, and before they get into a solid buying territory area. The main talking point this week was the Reserve Bank leaving interest rates on hold, which was almost 100% expected, and the GDP data, which came out on target, although there were a few nervous downside revisions leading into the release, and chatter about Australia going into recession for the first time since the early 90s. Household income grew 1.3% for the quarter, but is down from its average of 3%, and household savings fell 2.8%, almost half of what it was this time last year. The falling income, increased cost of living, growing debt burden and very slow growth makes a complex balancing act for the Reserve Bank. This influx of economic uncertainty, plus the emergence of Amazon into Australia, is weighing heavily on the Australian retail sector, namely the likes of JB Hi-Fi, Harvey Norman and Wesfarmers. Harvey Norman slipped 4.5% for the week and is now down some 35% from its mid-2016 highs. It's also fallen through moderate support, suggesting ongoing weakness towards the low $3 area is now highly probable. JB Hi-Fi fell over 6% this week. The technical outlook is similar to that of Harvey Norman, and ultimately we expect to move down towards $18 eventually, although scope for a decent bounce in the interim. The ASX 200 broader index fell 1.9% this week and is now 4.7% off its May 1st high point. We did an in-depth assessment of the index last night or Friday evening for members, and there were quite some substantial technical points to discuss. In summary, there's a very distinct pattern that started way back in early 2016 and appears to have terminated at the May 1st highs. The importance of this pattern is its symmetry and in both price and time, which validates its present. Now, this is important because the more validation a pattern has, or the more it conforms to its strict rules, the higher the probability that the ongoing progression will unfold as expected. And it's this higher probability that allows us to position ourselves for those bigger moves. And these were the exact same technical circumstances that allowed us to call the top of the market back in 2007 and the exact low in March 2009. If you do want to have a look at those reports, those large reports that we did, those special reports we did, you can log into the members area and see those, and also see the expected move that we're looking at over the coming 6 months in Australia. Over to the US, it was all a bit of a fizzer this week, right up until about 2:30 p.m. on Friday trading. Up until then, the Comey testimony was a non-event, and the UK election was significantly closer than expected, but more or less a non-event. And the ECB suggested a measured approach to rate increases was closer, but again, a non-event. So what happened exactly at 2:30 p.m. just before the US close on Friday? Amazon staged a mini flash crash, dropping some 8% in a matter of seconds before recovering. There appeared to be a system-wide sell order in the Nasdaq as funds rotated out of tech stocks, which have been the market leaders, and into the laggards, specifically the financials and small caps such as biotechs and retailers. Whilst the Dow Jones settled at new all-time highs and the S&P 500 was more or less unchanged, the Nasdaq lost 1.8%, and various names were smashed. Nvidia, which has been an absolute powerhouse for the last 18 months, slumped 6.5%, closed off its lows but was still down 6.5%. Amazon down 8% at one stage, closed 3.1% lower. Apple lost 4%. Tesla and Facebook also both dipped about 3.5%. We don't view this as anything serious, but suggest these stocks have powered ahead over the last 6 months, and many are due for some kind of a pause. The broader US market indices continue to look very, very positive from a technical standpoint. Now, we're going to be back with you next weekend, and until then, we'd like to hear your feedback on how this weekly podcast should proceed and could help you. Drop us an email or connect with us on social media. Let us know what you'd like to hear, what you're focused on. And in the interim, a reminder that Noosapalooza is just around a month away. We have about 10 seats available, but as was the case in Noosapalooza 2015, the remaining seats sold about 3 weeks out from the event. So make sure you lock in your ticket and spend a nice winter's break up here in Noosa. My name is Nick Radge, and I'll see you on the charts next weekend.
On the Charts with Nick Radge, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.